Applause, a nice warm welcome here for Bill Payne. Bill, get your presentation queued up. Thanks, everybody.
Thank you, Nathan. So I'm delighted to be here. I can learn about family offices today. Who knows? Maybe that's in my future. I've been writing checks as an angel investor since 1980. And I'd like to share with you some of my experience. But first, I'd like to sort of set the stage by giving you maybe a few slides on the angel investment community in the U.S., the ecosystem that we operate on, and then I'll spend the last two-thirds of the talk addressing, so what's important to me? Now, that doesn't mean it's important to Gary, who's also been an angel investor for probably at least as long as I have, but it's what's important to me, and I'd be willing then to share and answer your questions at the end of this, because I've only got about 20 slides and we've got 45 minutes, so save up your questions. I'd actually rather go straight to questions than go through these slides, but we'll set the ecosystem up here. Now this is as busy a slide as you will see in my deck, that's for sure, but it's a slide that explains the ecosystem that entrepreneurs work in. From left to right is the maturity of the company, from the idea stage all the way through becoming a mature public company. In the center, you've got generally the sources of capital that are available to entrepreneurs at those various stages. We expect entrepreneurs to use their own resources at the outset, but we're not going to invest probably until they've got market validation, or some form of revenues or a Kickstarter campaign or something that indicates that somebody would actually buy this thing if they could actually make this thing. So there's a gap between self-funding and angel investors, and that's filled by a variety of sources, and it's a growing source in that middle. Accelerators, incubators, crowdfunding, growth in government sources. But let me tell you what the biggest one on the page is, and that's friends and family. We at the Kauffman Foundation estimates that $70 billion per year is invested in entrepreneurs who are starting companies and are funded by friends and family. That's bigger than, in most years, that's bigger than VC, and that's bigger than angel. When you see the big bold line there is sort of cash generated from revenues. Of course, at the outset, there isn't any, so it's going straight down. And at some point in time, there's hopefully, sometimes there never is, but hopefully there's an inflection point in that curve where the company starts generating some cash from revenues, and that's where we angels tend to make our investments. Now, some of us invest in companies that are yet pre-revenue, but have got some maybe beta tests that are promising. Other angels invest later in companies that actually have some revenues. Other angels don't invest until the company's really pretty much close to positive cash flow from earnings. But the first revenues is generally where you will find the earliest angels investing, and I happen to be one of those seed stage or very early stage angel investors. Now, normally we don't see venture capital come along until the company is positive cash flow or at least generating some earnings, offsetting some of their cash burn with revenues. So in many cases, I would invest in a pre-revenue company, and frankly, Keiretsu doesn't usually look at companies until they have maybe $500,000 in revenues. I consider that pre-revenue. So there's a difference between no revenues and a small amount of revenues, but frankly, it's not overwhelmingly significant if the company has some market validation. Now, let's talk specifically about those angel investors. I think it's important to realize that we're all accredited investors, but we're almost all part-time accredited investors. So we spend way too much time on due diligence, and entrepreneurs get upset with us every day because it takes us too long to make a decision on writing a check. Typically, and this is true in my case for sure, we're investing 3 to 10% of our net worth. There are angels who indeed are all in angel investing. That's not me, and that's not most of the people that I know in this regard. Important is that we are investing both time and money in these portfolio companies. Now, not all of us are going to be a director, but we should be participating in due diligence, or we might help the company go through a M&A transaction later on down the road. So we are considered as a class active investors, not passive investors. Venture capital limited partners, as you know, are almost exclusively passive, and angel investors, most of them are active. Now, you can't be active in every company. There was a time when I had 30 companies in my portfolio, so I was on maybe 3 boards, not 10. But I have other things that I'd like to do too, like playing with grandchildren and going on cruises and playing golf and hiking in Glacier National Park. So I am a part-time investor. We angels, as individuals, write checks of $25,000 or $50,000. That is the predominant number. It's still, on average, about $27,000. But as a group of investors in a round, we might be writing a total of checks in the range of $500,000 to $1 million. It's very important for us to plan ahead, which I was guilty of not doing at the outset, and write more smaller checks instead of fewer larger checks, and to save some dry powder for follow-on rounds. Because our portfolio companies tend to run out of cash, and sometimes before they've met sufficient milestones to attract new investors. We have a strong interest in helping the companies, even in the due diligence, even before we write the check, in defining what their exit strategy is. This is totally baffling to entrepreneurs who have no idea why we'd be concerned about how we're going to exit from this company. And we have to explain to them that this is not philanthropy. We are not donors. We are investors. So there's an in and an out if you're a successful investor. And the out part is the thing that we really need to work on with entrepreneurs. So we start talking about that very early on. Now, why do I do this? I think entrepreneurial ecosystem in the U.S. is a very important part of our economy. And frankly, I'm in it to create jobs and to create wealth. Now, not necessarily just wealth for me, but wealth for entrepreneurs who will become the next generation of angel investors. Because I believe that angels are a very important part of the ecosystem. And so if I can help entrepreneurs be successful and help them become angel investors, then I think I have been a very successful angel investor. Now, how about impact investing? Well, I think the greatest impact we make as angel investors is job creation and wealth creation. And I am not so concerned about, I don't want to be involved in companies that are doing harm, that's for sure. But I think that job creation and wealth creation is the most important thing that entrepreneurs and angel investors do. Okay, what do we look at? Well, you wouldn't be surprised to find that management team is at the top of the list, and that the size of the opportunity is important. Because as you will find out in a moment, these companies fail much more likely as a likely outcome than they're successful. So we have to bet on companies can give us a 10x return or a 15x return or a 30x return. We cannot bet on grocery stores and mom and pop operations, lifestyle companies. If you want to do that, that's fine, but that's not likely to give you the kind of outcomes that you would like to have, and that is we tend to bet on companies that can give us a 10 or 15x every time. You can do some studies for yourself, but I will tell you that in doing this for almost 40 years, I've discovered there is no relationship between the scalability of a venture and its risk. Restaurants are low-scale companies. Their failure rate's about 70%. Software companies are a high-scale company. Their failure rate's about 70%. There is no relationship between those two. Quickly, let me run over returns. And I think this will give you some idea of how skewed this asset class is. We tend to look for, as a portfolio, about 2.5 times our money back over a period of 2 to 10 years. Now, the average hold time it shows there is 3.5 or 4.5 years. That's ridiculous. What happens in the first 3.5 or 4.5 years of the typical portfolio company? They go out of business. So it takes a long time to build a successful one. So, but the IRR of these portfolio companies, in most cases, can be very good if you have a sufficient portfolio. Look at that the less than 1x. That means not getting your money back. Wow, 50 to 70% of the time you don't even get your money back on these things. And all of our upside is created by about 10% of our exits. In fact, that may be a little exaggerated. If you think about the numbers in that right-hand column there, what you will learn is actually some of that return is return of capital from the 9 that didn't quite get there. So it takes more than 1 in 10. Let's say it takes more than a 25x on general from one company to give you enough returns to talk about a really successful portfolio. So, since we expect high returns, because this is high risk, and since 9 out of 10 of these companies tend to fail, we have to develop a relatively unique strategy as angel investors. And that is, number one, invest in a lot of companies. Number two, invest only in companies that will scale. That means give you the potential for a 10x or a 15x. Now, this bar chart, for me, is based on a significant amount, a statistically significant amount of data. I still find it astounding. If you make 6 angel investments based on a study of about 1,000 companies, you have a 50-50 chance of getting your money back. 6 companies, 50-50. But if you make 12 investments, you've got a 75% probability of 2.5 times your money back. And if you make 24 investments, it goes up to 90%. So there is something to be said for making lots of small investments instead of a few large ones, and to only looking at companies that will scale. This sort of sums up what I've been talking about for the last few minutes. Looking for a highly qualified team, a scalable venture, a product with some unfair advantage, a patent, trade secrets, etc. And if so, and if we follow these rules of scalability and a significant number of companies, we can enjoy relatively significant returns. Moving on. In fact, let me stop there. Any questions about sort of where I am right now, what the landscape is for the U.S.? Yes, sir.
Yeah, so looking at all of them, thanks. Do you think there's any common element of why startups fail? I know everyone asks that question, but I think there's more of a science to it than we thought.
People have been, why do companies fail? Well, if you look in the newspaper, it's because they can't raise capital. Nah. Why can't they raise capital? Because they couldn't execute against a plan. So in my opinion, it's almost all about the team executing. And that's why we put the team at the top of our list when we're talking about how to make a decision as to whether we're going to invest in a company or not. Now, there are lots of other reasons. You know, recessions happen, competition blindsides them. Tiny little companies like Microsoft come along and decide to be in the same business. A lot of reasons the company fails. In my opinion, and based on my experience, lack of execution on the part of the team is the biggest reason, and the inability to raise cash is not. If you hit your milestones, you're probably going to be okay. Now, you may not be a 10x, you may be a 2x or a 3x, but if the company executes against the plan and meets the milestones, they're probably going to be a positive exit. Anybody else? Yes, sir.
How important is diversification by sector?
Good question. We have no data that says that diversification by sector is important. For example, we don't know that angels make more money in life science or in software or in hardware or in consumer products. In fact, there's probably a general thought that if you invest in what you know, you're probably more likely to be successful than if you invest in a variety of things, including stuff you don't know. So my suggestion, at least for new angels or for those who haven't made too many startup investments, is stick close to your knitting until you get engaged with a larger group of people and you figure out, you know, people are investing alongside me and I'd like to invest alongside them, and then maybe you sort of dip your toe in the water outside your area of expertise. Yes, sir.
Since you wrote your first check in the 80s, now the market there's more opportunity for investment. There's companies out there seeing this as a way for them to grow. How have you seen the change in the investing landscape over the last, let's say, 10 years affect the way that you kind of taught yourself in the 80s into the 2000s?
So the question is, how has angel investing changed perhaps since the 80s? The biggest positive impact on angel investment in the U.S. is the formation of angel groups. In other words, you can join Keiretsu Forum or the Alliance of Angels or the Puget Sound Venture Club or the Tech Coast Angels or the Golden Seeds or angel groups all over. There are 400 angel groups in the country. 250 of them are members of the Angel Capital Association. That has made it much easier to create a significant portfolio. It was really hard to find deals at the outset before you could identify other angel investors. So I think the biggest change has been the availability of groups all over the country to join. Crowdfunding, yes, it's had a small impact, but if you look at the crowdfunding that's dedicated to this space, it's far less than 10% of the amount of angel investing that's going on. There are other issues that are impacting our ecosystem, but I think investing with other like-minded people through angel groups has been a really big and important trend. Okay, let me move on to cover the rest of this material, and hopefully that'll leave us enough time for some additional questions. So The slide that I showed you on returns was mostly work done, actually, in Portland, Oregon at Willamette University by a fellow by the name of Rob Wilkbank. And he also studied at the same time due diligence. And if you look at the amount of time dedicated to due diligence as a bell curve, the peak of that bell curve is about 20 hours. So some deals were done on the back of an envelope in a coffee shop, and some deals were done after 100 hours of due diligence, but the peak was 20 hours. If you did 20 hours of due diligence, your returns were 1.1x. You got your money back plus 10%. If you did 40 hours of due diligence, it was over 5x. And if you did 60 hours, or 20, it was 5x, 40, it was 7x. So due diligence is really important. Now, fortunately, we syndicate a lot of deals with a lot of different groups, and we share due diligence with each other. So it's relatively easy to get people to help you due diligence or share due diligence on deals, and that's much different than it was 30 years ago. I think this is probably true of Kibitsu, and I think it is true of many groups, is the more successful groups spend cumulatively more than 100 hours on due diligence. So what's the lesson here for family offices? Get paired up with an angel group that's doing lots of due diligence, and share their deals. Invest alongside them and show your deals to them. In due diligence, we generally, as an angel group, we divide up the work among 5 or so of us. We look for people who've got the right kind of background in our group to do that work, and we spend a lot of time with the entrepreneur. I think that's really an important message in due diligence. Since companies fail because of lack of execution, we better spend a lot of time with the entrepreneur and the team and figure out what's going on there. Understand that we're going to write a pretty good report for the other investors in this round, and if we have to go outside of our group, for those in other groups who would like to look at this deal with us. Personally, I'm going to go off and share with you my opinion with respect to structuring deals. I like price rounds, not debt. I like preferred shares. I like the concept of shared governance, which means that the entrepreneur doesn't control the board of directors and the investors don't control the board of directors. They participate, and there are independents who make up that 5th board member if you've got a 5-person board of directors, a couple of founders, and an investor or two. I like it vanilla terms, which means that I make it easier for follow-on investors to come along and invest alongside of us. I don't like to see too many onerous terms in term sheets for entrepreneurs. What don't I like about convertible debt? I realize a lot of convertible debt deals are done. About 30% of the deals in the Angel Capital Association are convertible debt, and more like 40 or 50% of deals in the U.S. at the angel level are done with convertible debt. What's convertible debt? It means you're loaning the company money and you're converting to equity at a triggering event, which is usually the next round of investment. The assumption is that we angels don't know what the hell we're doing, and the smarter guys are going to come along and put down a really useful term sheet for the entrepreneurs. I don't think that's necessarily true in this day and age. What I have found about convertible debt is that it almost never converts at the price at the time, the price of the company or the value of the company at the time we loaned the company the money. We created the note. It's always at some inflated price as a discount off of a subsequent round. Furthermore, there's almost no voice in the boardroom for angels who are writing checks for through debt. And I have also seen in many cases the terms of the note were not recognized by the subsequent investor, who put a term sheet together for the company that said, nah, we're not going to give them a 30% discount, even though it's been 3 years. We'll give them a 10% discount off that next round. So they're not honoring the terms of the note. Finally, if the company is wildly successful for our $1 million note that we gave them, and they sell the company before the triggering event, they're going to give us twice our money back, or maybe 3 times our money back, instead of 20% of the upside, which is probably what we funded. So that's why I don't like convertible debt. Valuation, the typical valuation in the U.S. for companies that are just beginning to have revenues is about $4 million. But like real estate, it changes with location. Trust me, valuation for startup companies is higher in Silicon Valley than it is in Boise. You just have to trust me on that. It's also true that it's higher valuation in New York City than it is in Rochester. So entrepreneurs, though, they read TechCrunch and they assume a startup is a startup is a startup. So we run into these kind of problems all over the place. While we are impressed with the quality of the team and the size of the market and the strength of the IP, we also recognize that there are economic cycles in this country, and good times valuations are high, and in bad times valuations are low. In fact, there's a lot of similarities between the real estate market and the startup companies as far as valuation is concerned. Boards. I like shared governance. That means a 5-person board or a 2-person board where the founder or the founders or the common shareholders before the investors came along own 1 or 2 board seats out of 5, and 1 or 2 are independent, and 1 or 2 are investors. So total of 5, maybe 1 investors, 2 independents, and 2 founders. And I have a few examples in my portfolio where the founders had controlling interest of the company and decided to make a nice lifestyle company out of it. So 15 years later, there's still no exit in sight for the investors that put up the money. I'll let you read the rest of that slide. Smart practices for boards. I like monthly meetings until the company has positive cash flow. When the company is not eating my cash, but is now generating enough cash to proceed, we can talk about quarterly meetings or something that's different than monthly meetings. At the beginnings, I'd like the first 3 things on the agenda are cash, cash, cash. And then we talk about runway. And then we talk about when we're going to raise more money. And after that, we can talk about other issues that the company might address. As my friend in Columbus, Ohio, John Houston, has said, and many times, until he exits, we're donors, we're not investors. And we see, in this business with 50 to 70% failure rate, we're donors more often than we're investors. So I really like to see a focus on exits from the outset, from the due diligence period forward. Now, does that mean that we're building a company to flip? No, it doesn't. I don't view it that way at all. Selling a company simply is the next step in the financing of that company. They're just going to take it from there with bigger bucks and deeper pockets than we have. We can go raise VC, or we can sell the company to somebody with much deeper pockets who is going to help that company build out its portfolio into the future. Syndication, I did mention this a little bit earlier. Years ago, we just didn't know how to syndicate deals. It was all friends and friends of friends that we invested with as angels. Now there are all kinds of opportunities, not only just angel groups, but family offices, crowdfunding platforms, big solo angels or mini funds or micro funds as they call them these days. We invest a lot with them. I think I just saw a statistic the day before yesterday that in 2017, 73% of angel group deals in the U.S. were syndicated with some of those people that you see on the slide behind me here. Smart practices with respect to syndication. We're all investing in the same term sheet. We all agree to hold each other harmless. It's our responsibility to do due diligence, even if we use your due diligence report. There are no fees generally charged to syndication partners. And the entrepreneur, for a larger syndication investment, might have to go and visit the far-off group that wants to put some money in this deal. So it's not going to be a local sport any longer. So a couple of suggestions. If I were running a family office, and I'm not, you are, you're the experts, but I would hope that you would allocate a small fraction of your portfolios for early stage deals. Write smaller checks for a larger number of deals rather than larger checks for a smaller number of deals, and hold some money for follow-on investment, because you're going to want to invest in the ones that are really, really doing well. Syndicate with stronger angel groups in your region or actually throughout the U.S. It's pretty easy to reach out to them these days through the Angel Capital Association. Be prepared to syndicate in and out. So you can syndicate with Kiritsu or other angel organizations in the Northwest, but also remember that they're probably going to want to look at your deals too. It's sort of a two-way street. And some of the things that we angels don't focus on enough is boards and exits. And those are two pet peeves of mine, is when I see my fellow angels not spending enough time on boards and exits. And that's it. What other questions do you have for me?
All right, thanks so much, Bill. Round of applause here for Bill Payne, just to give Bill a chance to catch his breath. And we've got a couple mic runners on each side here, so if you do have a question, raise a hand, get the attention on the left or the right, and we'll try and keep the questions quick.
Throw it out.
Let's try and get as many as we can. Right up here, we'll get started, Brian.
So you don't have to answer if you don't want to, but you've been writing checks for almost 40 years. How have you done?
Actually, I've done pretty much the question is how have I modeled my returns? They're actually pretty similar to what you saw reported here. It is difficult if you write lots and lots of checks to do a lot better than that, because actually the statistics say you come back to the norm. You might write 5 checks and have 3 winners and 2 losers and do way better than the data that I showed you. But if you write enough checks, you're going to get the norm, and that's essentially what I've done. Yes, sir.
Dan Collin.
Thanks, Nathan. Hi, Bill. Good to see you again.
Nice to see you.
So you talked about onerous terms that can burden a company for its next or subsequent rounds of capital.
Yep.
Could you outline a couple of disaster stories, or could you talk to what, in a perfect world, what you'd like to see?
Well, let me just give you one example. A liquidation preference means that the investor gets their money back ahead of all the founders in the company, all the common shareholders, in the case of an exit. And this is probably reason that this term exists is that we don't want to give the entrepreneur $1 million and then find him on the beach in the Bahamas or some other place. So, or having sold the company for them for $1 million because that's what they had in the bank, and now they're on the beach someplace. So anytime there's an exit, we're going to get our money back first. But and there are forms of it that say we have to choose, get our money back or take our fraction of the upside. And those are both reasonable sets of terms, and we see them both all the time. What is unreasonable is a big multiple of that. Let's say 3 times my money back before the founders get their share. Now, the bad part of that is, yeah, the entrepreneur's getting ripped off, but the other thing is subsequent investors are going to require the same thing. So you add a lot of investment with a 3x liquidation preference on top of that, you may get shut out. So it's not only onerous for the entrepreneur, it's onerous for you. And there are a variety of such terms that you want to be just very careful with.
Mike Stein?
Hi, Bill. When would you ever, this is something I saw in Shark Tank, I thought it was an interesting strategy. When would you propose a term where you say to the founder, I'll give you $1 million for the 20% of the company or whatever the deal is, but I want 10% of your revenue until I get 3 times my money back?
So revenue capital is actually one form of investing. You do see situations where there's a combination of equity and revenue capital. Revenue capital simply means you get a cut of the revenues or cut of the earnings, but probably the revenues as part of your return. I would say the times that it makes sense are in situations where there is a hesitancy on the part of the entrepreneur to give up a significant fraction of equity in the company. So you take a little of each. You take take a share of the revenues, and you take a piece of the action. Now, what is about the case where you see an opportunity that you think is tremendous, but you also see a case where the entrepreneur probably is never going to want to sell the company. It's just a nice little, very big lifestyle company. I would definitely look at revenue capital in that case because I'm probably never going to be able to sell my equity. At least I'm 77, not in my lifetime anyway. Any other questions? Yes, sir.
I mean, as you start investing more, like, one of the things that becomes hard doing a presentation is having that board position or having some level of oversight and control at that level. The more companies you invest in, the less control you have. How do you focus your effort?
Yeah. So the question is, well, I'm going to be invested in 20 companies at the same time, and Payne, you said you got to be involved in the boards. Well, but remember, I'm also investing with 15 or 20 other investors on, well, let's say 10 to 20 other investors in most of those deals. So I may only go on, let's say, 3 boards or 2 boards or 4 boards. But I expect one of the other investors, maybe somebody that's got a lot more vertical expertise than I do, to be the board member in the next deal that I do, or the last deal that I did. So how well? We got 26 seconds. Yes, sir.
Go, Ron.
What character traits or qualities do you look for in individual entrepreneurs?
I look for integrity. There's no such thing as a little white lie when it comes to entrepreneurs that you're going to invest in. And I look for coachability. Now, why would coachability be important? Well, I'm going to be heavily, or somebody in the investor in that round is going to be heavily involved in helping that company as a director, as an advisor, as a coach. And there's nothing worse for any of us than an entrepreneur who says, yeah, and then goes on and does his own thing anyway. So if you believe the company would benefit from the advice and counsel of experienced business people, but you're concerned that the entrepreneur is not going to listen to them because they already know everything there is to know about running a company, even though this is their first shot at it, then I'm probably going to go in another direction. Now, there are other things that are important too. Vertical expertise, having some managerial experience, supervision or managerial experience. I think there are several other factors, but coachability and integrity are the first thing I look at. And I think you can sort out coachability pretty easily, and you can do some background checks, etc., to figure out whether integrity is likely to be in this particular entrepreneur. So anyway, thank you very much. I appreciated being before you.
Thank you so much, Bill. Again,